Well, welcome everybody. Steven Sitkowski here. Glad to have you for this edition of Market Insights. It was a fun day for yours truly. The first day of skiing. It's been kind of a late season. We've been waiting on snow. We finally got it, so we went up and fully enjoyed it today. Beautiful bluebird day. High, I think, was about 40 degrees. Snow was in good condition, nice and soft, perfect for making those cars. Anyway, it was fantastic. Can't wait to do it again. Hope your weekend was amazing, but that's not what you're here for, is it? Well, it should be, but I think you probably want to know what's going on in the markets. I was pleasantly surprised, after one of the announcements about Jerome Powell and the fact that he was going to come under investigation by the Department of Justice for what I have no idea. Um, I don't play in that sandbox. I happen to be a fan of Chairman Powell. I think all in all, the guy's done a pretty good job, navigated us through COVID, um, kept the economy going through there. We've gotten inflation back under control. That is more the Fed than it is politicians. I've been fairly happy with the job that he's done. Would I like to see interest rates lower? Yeah, everybody wants to see interest rates lower, unless you're at the bottom of the food chain and you understand that lower interest rates means higher inflation and you can barely afford to feed your babies, when you look at the prices at the grocery store. So there's a balancing act that takes place there. And from what I can see, I think the guy's done a pretty good job. So hopefully this all works out for him. I really expected to come home and find the market lower. That was my anticipation. Last night, futures were lower on the news, and that's not what happened. The market actually closed up today. So, a whole lot of resiliency there. I want you to know that everything that we do here is for educational and informational purposes only, should not be construed as investment advice. So, what's moving the markets? The S&P and the Dow hit fresh record highs in spite of what I think was some fairly negative news. But this market just keeps moving. Since it's bottomed out in October of 2022, it really has been a juggernaut. The president calls for a 10% cap on credit card rates. I guess this is a moratorium for 1 year. And again, without getting political, how do you tell a business what they can charge for their product, right? Do you call Chevy and say you can only charge this much for a truck because not enough people can afford to buy your truck? Where does it stop? It seems to be the opposite of what capitalism is based on. The market determines the value. Now, I'm not naive to the fact that there are a lot of people who get hurt because they get into serious credit card debt. I mean, I get that. And I think it's an absolute shame. I was there when I was a very young man at one point, but I wasn't waiting for the government to step in and, like forgive student debt. That was a different administration. I was 100% against that. What about all the people that paid their debt? I'm just personally, this is just me, not in favor of the government dictating to business, unless it's a matter of national security, what they can and can't produce, what they can and can't charge. I'm just not. So I read this and I just shook my head. How do you do that? Think of all the banks that are out there that are running a business model, maybe predicated on 17% interest coming in from credit cards. And now all of a sudden you whack their revenue stream. And for what? Because people have gotten themselves into debt. So guess what's happened with a bunch of bank stocks? They've come down. And those very same people you're trying to protect might very well have a 401k that is invested in an index or a mutual fund that owns that very stock. I don't know. Maybe I just think different than the average person. I suspect the average person is, yeah, put a cap on those greedy banks. Was there anybody forcing anybody to go out and take a 17, 18% interest rate credit card? Wasn't that a matter of free will, a deliberate choice? Right? Exercising your right, as it were. CPI data is due out Tuesday. I think the forecast, Tuesday tomorrow, is at 2.7%. Still a way away from the Fed's target of 2%, but we haven't sniffed 2% in years. But it'll be interesting to see what direction inflation is moving month over month. 10-year Treasury pretty steady at 4.185. That's a great interest rate for stock investors. There's nothing competitive about it. And oil prices ticked up just a little bit, but again, and I got this totally wrong. I would have thought with what happened in Venezuela that it would have shot oil prices higher. And they've moved a tiny bit higher, but no higher than we would expect just due to their running their natural course. So that's kind of where things sit. A whole lot of boring, except for the S&P and the Dow. And by the way, what's outproducing them recently has been the Russell 2000. So a lot of good news on that front. Market breadth was um, pretty darn strong. You look at advancers versus decliners on the New York Stock Exchange, almost 3 to 1, and greater than 2 to 1 advancers over decliners on the NASDAQ, which of course is tech heavy. Stocks hitting 52-week highs on the NYSE, 414, hitting new lows, 89. You gotta love that. On the NASDAQ, 700 new highs compared to 250 new lows. All of that just looks terrific. Couldn't ask for more. This is some more good news. Look at what the trend has been here for stocks trading above their 50-day moving average. I mean, it's gone vroom, vroom. 66% of all publicly traded stocks, this may just include the S&P, but 66% are trading above their 50-day moving average, which means they're moving in a bullish direction on an intermediate term basis. We've had a little bit of sector rotation. So who's taken the lead so far this year? Keep in mind, the year is young, but materials up 6.42, industrials 4.39. Notice communications, which led last year, is at 0.16, and technology, which finished in second place, 1.51. That's what I mean by a little bit of sector rotation. Companies that have started 2026 with a bang. How about SanDisk? Up 58.99%. Lam Research, I built a whole man cave off of one trade on Lam Research years ago, up 27%. Intel, I'm doing covered calls on Intel, up 23.44%. Builders First, Source up 21%. Micron Technology's been on a tear, up 20%. And you see the rest of it. A couple of oil-related stocks. Schlumberger is on there. Halliburton is on here. Valero Energy. Okay. So where are the earnings going to come from? Like it or not, it is still all about the Magnificent Seven. Look at the other 493 stocks that make up the S&P 500. They're forecasted to be down 2%. Their earnings. Magnificent Seven up 10%. Most of what I've read from analysts, and this is from Goldman, um, they're looking at earnings growth for this year somewhere in the 12% range. GDP's been revised upward. Look at this. I mean, over 5%. That's a great economy. We would kill to have GDP grow at 5% a year on a regular basis. So that's the estimate for the fourth quarter of 2025. But, it's a bifurcated economy for sure. You have the group that's struggling down at the bottom, and the people at the top are flourishing. Hiring rates been circling the drain. Check this out. I talked to more and more people that have said, they have a friend, they have a family member that's been looking for a job, and they're tough to come by. And just wait until AI takes full effect. I frankly think that the average young person's probably better off learning a trade than they are learning advanced math skills. Because guess what? Computers can do advanced math skills. Computers aren't going to put wiring into a house. First time home builders, look at this. They're priced out of the market. So maybe the government should tell home builders that you've got to take $100,000 off of every house. I mean, that's the logic, right? With the credit card interest rate. So mortgage rates have fallen. 30-year fixed I saw was at 5.99%. I think, you get a five handle on mortgages, you're probably in pretty good shape. But the average price of a new home in the US now is $450,000. That's a lot. You're going to have debt service, you throw in taxes and insurance, probably in the neighborhood of 3 grand a month, which means you got to be making 10 grand a month to qualify and have good credit, and not everybody does. Here is last week's heat map. You can plainly see more green than red, even though Apple, Nvidia didn't have great weeks, but Amazon was up, 9.22%. Over consumer defensive, looks awfully good. Industrials did great, but by and large, as you saw with market breadth, everything looks terrific. So these people that talk about AI being in a bubble, promise me you're going to not listen to them. Global AI computing capacity is doubling every 7 months. Does that sound like a bubble to you, or does this look like a parabolic rise? Now, at some point, is this going to flatten out? It has to, but no time soon. Market sentiment remains very strong. So when they survey AAII, these are independent investors, members, ask them where the market's going to be in 6 months. Historically, 37.5% say bullish. We're hanging in here at 42% plus. Now, the bearish is about where it normally is. Bearish is typically 31%. We're at 30%. We're just kind of eliminating the people in the middle. And we're getting ready to start earnings season. So it's going to kick off as it always does with the financials. So we've got JP Morgan. Now, Delta's not a financial, but you get some insights into travel. BNY Mellon. Who else we got? Wells Fargo, Citi, Bank of America, Goldman. So we got some investment banks, BlackRock, Regions, State Street, PNC, M&T Bank. So the great thing about having the banks kick off the earnings season is they've got a pretty good beat on the consumer because that's who they service. It'll be interesting to see how many, if any, comment on the potential of this 10% interest rate cap. Let's take a look at the charts. Charts ought to be in good shape, and kaboom, they are. So this yellow line is a 50-day moving average. We see it sloping higher. That's bullish. We see that the market closed well above the 50-day, also bullish. So, yeah, everything on that chart looks as good as you could want. Nothing crazy where you've got to forecast a pullback, just nice, steady growth. Let me see what happened today. New York Stock Exchange, we had 1,580 stocks that were higher, 1,153 were lower. So the difference was plus 427. On the NASDAQ, it was plus 456. And then new highs versus new lows on the day. On the NASDAQ, 372 hit new highs, 94 hit new lows. On the New York Stock Exchange, 233 to only 18. Man, these are the times, gang. These are the times to make your move. Make sure you're in the right stock. Stick with companies growing earnings and growing revenues and expanding their margins and where the big institutions are in on them. You do that, you should be in great shape. I still think 2026, we're going to see double-digit returns this year. I've had people scoff at me for that prediction, but it's okay. I can handle a scoff. Anyway, have a fantastic week, and I will meet you back here same time next week. Bye for now.